cover some of those areas actually, so some helpful tools on helping you and supporting you and your customers through this turbulent market. So having a look here, I wanted to firstly start by just again highlighting the turbulent market. Yesterday we saw many changes due to the spike in swap rates, and I know Craig referenced this in the panel debate, but for those of you that are unsure, swap rates are used by lenders to hedge against interest rate risk posed by offering fixed rates. So some lenders buy hedges or tranches at certain costs to support the provisions for their fixed rate mortgages for a certain period of time. That locks in their margin, and a swap rate is basically swapping a variable rate for a fixed rate, and is used by many as a good predictor for what the market believes interest rates will be. So there are 2-year swap rates, there are 5-year swap rates, 30-year swap rates. Craig gave a great example actually of 2-year swap rates, how they've risen from 0.8% of this time last year and are almost at 5.5% today, just showing how steeply they've increased. And in fact, on the screen there, you can see on the right-hand side, there's a graph, and you can see absolutely how steeply swap rates have climbed in just this short period of time. Because of this, there will absolutely be product withdrawals across the market, and there is little that lenders can do as they need to protect margins and ensure they're not making a loss. However, one thing that can be done is to give you as much notice as possible. I saw a very informative LinkedIn post yesterday highlighting a few lenders that only gave a couple of hours notice before withdrawal, and in fact actually some that confirmed it was with immediate effect. And it is a very challenging market, but Kensington, we want to be able to be as supportive as possible in this marketplace, and we strive to always give 48 hours notice on our product withdrawals. If like yesterday that wasn't completely possible, we were still able to pull through and able to give you a full day and a half's notice. So that's probably more of a tip for lenders than a broker tip, but definitely one of the top broker tips I would give is to check what actually secures your rate for each lender. Each lender uses a different system. For example, Kensington, we need you to press the Start Full Mortgage Application button and move on to the applicants page, and at that time you can save and exit, but without commencing that mortgage application it won't secure the rate. So you just need to make sure you're checking what each lender's magic buttons are really. So each lender will confirm this on their product withdrawal emails, what is exactly required, and I appreciate you're absolutely getting a lot of those at the moment, but this will ensure that you can secure that rate. And now from the poll, we saw that 27% saw that remortgage demand is on the up, and from 27 Tech, they confirmed 10% up from last year, which isn't surprising knowing the lack of housing stock there is in the market. Remortgage conversations will absolutely be harder as customers are expecting their costs to decrease, and they may not have experienced a market like this before. My tips would be to know what lenders have more flexibility, so more affordability options. All lenders are absolutely restricted by ONS data, and we know this continues to rise, making lenders more restrictive with their affordability. So looking for lenders that can maximise customers' income on the top part, so allowing 100% of variable income, different income streams, unusual income streams, affordability boosting products, just like we offer here at Kensington, will be a good way to help look at different options for those customers. We also heard from 27 Tech that debt consolidation searches are up by 44%, and it's brilliant to see the market being so proactive. So absolutely continue this, discuss with your customers their budget, help them understand what things are essential, as nearly 40% of adults in the UK don't feel confident managing their own money. And of course, with remortgages, particularly as affordability tightens and becomes more challenging, like we mentioned, having the ability to do product transfers will become very important. At Kensington, we email brokers out 4 months in advance and give you access to our straightforward system that allows you to do product transfers within just a few moments. My next tip is kind of what Richard covered in the panel debate as well, around green mortgage availability and the importance of this. Now, it's something that from the polls you haven't seen much of yet, but if it saves customers money, I'm sure it will be something that becomes more a topic of conversation as time goes on and more popular in time. Understanding if they can have a cheaper rate now by asking what their current EPC rating is, or asking if they're planning to make home improvements that would improve their EPC. Those types of conversations can become crucial and help those savings. Another top tip would be to know what lenders' current service levels are. I've actually seen some fantastic questions come through commenting on this. With how quickly the market is changing, it's good to know how important service is to customers when giving them advice. If you think about your conversion rates with lenders, if you get a no from a lender after waiting a week or two after submission and have to go back to resource, absolutely, I'm sure you'll all know that the market will have moved significantly in just that short time frame at the moment, and you'll be going back to the customers with a very different available rate. Which of course leads me on to my last biggest tip. Stay close to your lenders, to your BDMs who are keen to support you in this challenging time. We are working on ways to help in the current marketplace, looking at new innovations to allow you to say yes to more of your customers. I hope that gives you a little bit of guidance around what we're working on here at Kensington and some of our challenges too, but we are still here and we are still wanting to support you and the broker market as best we can. But I'd now like to welcome Craig back onto screen to run through some of the latest Kensington news in our Kensington Business Update. So over to you, Craig.
Thank you very much, Eloise. So yeah, I'll just do a couple of things that are happening here that lots of people are asking about. So the first thing is, you may be aware that we are in the process of being sold to Barclays. They're committed to keeping us as a separate business. So hopefully it will just give us some big financial advantages and the backing to do more innovative products. So in terms of where that is, as some of you guys will know, we're going through a change of control process, which needs FCA approval. We're hoping that will be done in the next couple of months, but obviously it's kind of outside of our control because it is FCA approval is all we're waiting for. Everything else is done. So hopefully maybe November time-ish, we will get that across. And then, like I say, we'll be looking to launch lots more innovative new products for the specialist market. Service has been a big thing. I know obviously the biggest thing on the survey that we did earlier, your biggest challenge was lenders pulling products. We do try and give 2 days notice for product withdrawals. Unfortunately, the one we're in at the moment, we did only give a day and a half's notice, so I do apologise for that. It was all a bit of a shock yesterday morning when we came into work to see what the financial markets were up to. But in terms of our service levels, we have been at a 1-day service level every day this year. We've not moved from that. So that's nearly 9 months of a 1-day service level. So we've massively invested in the business to increase the number of underwriters to serve you. And as an example of that, we've had 25 cases offered in less than 2 days this month, which for a specialist lender, I think is pretty good going. I'm very happy with that. And we're also working really hard with the underwriting team. Again, feedback from brokers that we've had previously is that they really like to speak to the underwriter direct. So you have direct access to our underwriters. And in fact, our underwriters have made more than 4,000 outbound calls to brokers. That's what we do in a normal month. So most cases will get 1 or 2 calls from the underwriter to you, which then just cuts out all the confusion and allows us to get to a really good offer. And our normal app to offer time at the moment averages about 15 days, so about 3 weeks, we'll get you an offer. So more product innovation and development as well. So I talked about that with the Barclays deal. Interesting to see that just on the previous survey, you thought there was a big increase in demand for long-term fixes. We do have our 30, 40-year fixes. They're at a pretty good rate at the moment, so customers can lock in. There's lots of ways they don't need to pay the ERC. So if they move house any time in that period, they can walk away from the product. They don't have to pay an ERC. So that's definitely something worth considering as well. But I would just say thank you all for you to join. You know, we've had nearly 800 brokers on this webinar, which is amazing, especially when I know how manic everything is today, especially with all the product withdrawals. So I would thank you very much for your attention, and I'll hand you back to Eloise to wrap up.
Thank you so much, Craig, and absolutely echo that. Thank you to everyone for joining us today, to our guest speakers, and of course to you as well, and for participating as well as watching. So really do appreciate your insight and comments. When you exit the webinar today, you will be presented with a short survey. If you could take the time to complete this, it would be really appreciated. Please do let us know what you'd like to hear about next. Like today's webinar, it's been created by popular demand based on your feedback, so it really does go a long way. Please do follow us on LinkedIn as well, where you will receive our latest webinar news and when the next webinar will be. So please do head over there and give us a follow.